Most of us are taught that keeping cash in a bank account or a safe at home is the responsible financial choice. It feels secure because the numbers never go down. But look at this graph. The flat line is 100,000 rupees sitting in cash. That second line, climbing steadily above it, represents inflation, growing at around 6 to 7% a year. It acts as an invisible force, steadily eroding the purchasing power of your money. Extend this out over a 5 to 10-year timeline, and the gap becomes severe. The 100,000 rupees you saved a decade ago cannot buy the same goods today. The cash hasn't disappeared, but its value has. Because of that yearly decay, simply saving money is mathematically insufficient. You have to aggressively grow your cash just to break even with the cost of living. The most reliable engine we have to outpace that inflation is the stock market, specifically investing in the top companies driving the Indian economy. But buying individual stocks creates an immediate barrier. To do it well, you need significant capital, specialized financial expertise, and the time to monitor daily market fluctuations. Most working professionals don't have that. A mutual fund solves this. It pools small amounts of money from thousands of investors, aggregates it, and uses it to hire a professional to navigate the market on their behalf. It's designed for total accessibility. You don't need a fortune to start. As long as you have a PAN card, a bank account, and a basic KYC setup, you can begin investing. But there is a catch. The mutual fund industry is heavily monetized. If you want your money to actually grow, you have to know exactly how to navigate the internal structure of these funds to avoid being drained by hidden fees. When you hand your savings over to an investment firm, the first question is always, what happens if this company goes bankrupt or someone runs away with my money? In India, the industry operates under the strict authority of SEBI. They write the rules, monitor operations, and can instantly revoke licenses for foul play. Here's how your money flows. You fund an asset management company, but they can't hold your assets. They split responsibilities. An independent custodian holds the stocks, an RTA tracks your ledger, and SEBI oversees all three simultaneously. Because the system is structurally segregated, your primary risk of losing money isn't outright fraud. Your primary risk is making the wrong structural choices when you set up your investment. That brings us to your first major decision: open-ended versus closed-ended liquidity. Open-ended funds let you buy or sell anytime, giving emergency access to cash, but tempting you to panic sell during market dips. Closed-ended funds lock your money away until a specific maturity date, enforcing discipline, but completely removing your flexibility. Next, you have to decide who is driving those investments. This is the choice between active and passive management. Active management means you are paying a high premium for a human fund manager. Their job is to actively research and hand-pick specific stocks, trying to outsmart the broader market. This matrix breaks down the alternative. Passive or index management removes the human entirely. A computer simply mirrors the top companies in the market, like the Nifty 50. You accept the market average return, but in exchange, your management fees drop to rock-bottom levels. For most beginners, an open-ended passive index fund offers the ultimate balance. You retain access to your cash while capturing the market's growth without paying exorbitant management fees. The third decision determines what happens to the profits and dividends those underlying stocks generate. You must choose between IDCW and growth. The IDCW, or payout plan, takes the cash dividends and deposits them directly into your bank account. It provides immediate, short-term cash flow that you can spend today. The growth plan does the opposite. It takes every single rupee of profit and automatically uses it to buy more units of the fund, rolling the money back into your principal investment. This chart projects a 20-year horizon for both strategies. The IDCW line grows linearly and slowly. The growth line curves aggressively upward. By constantly reinvesting the profits, your returns start generating their own returns, creating an exponential compounding arc. Withdrawing your dividends neuters the math of compound interest. If you want to build generational wealth, selecting the growth plan is mandatory. Now we reach the most dangerous choice in the mutual fund ecosystem: the decision between a regular plan and a direct plan. Regular plans are sold to you through a broker, a third-party app, or a bank employee. They help fill forms, answer your questions, and set up your account. In exchange for that convenience, the asset management company silently deducts a higher total expense ratio from your balance every single day. That extra margin pays a lifetime commission to the broker who sold you the fund. With a direct plan, you bypass the middleman. You complete the exact same KYC paperwork on your own. In return, the fund charges you a significantly lower expense ratio. This bar chart shows the long-term damage of that fee. Over a 30-year projection, the direct plan hits 1.52 crore. The regular plan stops at 1.25 crore. A 1% fee difference cost the investor 27 lakhs in lost interest. Rejecting the broker's help and manually clicking direct plan is the single most valuable action an investor can take. It secures millions of rupees for your own portfolio. Let's pull all of these decisions into a single strategy. When you open a fund, check these boxes. You want a direct plan, a growth option, a passive index fund, open-ended access, and focused on equity. Finally, apply the funding mechanism. Set up a systematic investment plan, or SIP, to automate a monthly deduction straight from your checking account into the fund. This specific combination creates a low-fee, high-growth portfolio. It requires zero daily maintenance and runs completely on autopilot. Keep in mind, this strategy requires time. If you need cash back in under 3 years for a wedding or a down payment, you should be looking at short-term debt funds, not equity. You also need to avoid the final beginner trap, the myth of net asset value, or NAV. Many beginners assume a fund with a 10 rupee NAV is a cheaper or better deal than a fund with a 100 rupee NAV. It isn't. A lower price just means the fund is newer or it has issued more units to the market. You can entirely ignore the NAV price. Put your focus on the quality of the underlying assets the fund holds and keeping your expense ratios as low as possible. Investing doesn't require predicting the future or trading on daily news. It requires setting up the correct automated system today and letting the broader economy outpace inflation for you.